There is a man in Connecticut who has $430 million. Not in a bank, not in a vault, not on a mattress. His money sits inside a structure so quiet, so invisible, that if you searched every database in America, you would find nothing with his name attached to it. Meanwhile, there is a woman in Ohio with $212,000 in her savings account. She sleeps well at night because she can see the number glowing on her phone. She thinks that number means safety. It does not. It means exposure. Every cent she has is visible, taxable, seizable, and earning her almost nothing. She is holding her money in a glass house. He is holding his inside a fortress made of air. The difference between them is not income, it is architecture. My name is Zik, and today I'm going to show you the 7 quiet strategies the ultra-wealthy use to protect their money from the very institutions most people trust with their entire financial lives. This is not a conspiracy, this is mathematics, and once you see it, you cannot unsee it. 1. The custody illusion. Let us start with something most people never question. When you put $100,000 in a bank, you believe you have $100,000. You do not. What you have is a promise. A digital IOU from an institution that has already lent out 90% of your deposit to strangers. This is called fractional reserve banking, and it is not a secret. It is the foundation of the entire system. For every dollar you deposit, the bank is legally allowed to keep only a fraction on hand, sometimes as low as 0%, depending on the country and the regulation cycle. The rest is loaned to businesses, mortgages, credit cards. Your money is not sitting in a vault with your name on it. It is circulating through the economy, generating profit for the bank, not for you. Now here is where it gets uncomfortable. If enough people walk into that bank on the same Tuesday morning and ask for their money back, the bank does not have it. We have seen this happen. Silicon Valley Bank collapsed in 48 hours. Signature Bank followed. In each case, people with deposits above $250,000, the FDIC insurance limit, were staring at screens wondering if their life savings had just evaporated. The billionaire class understood this decades ago. They do not leave meaningful wealth inside a system designed to use it as raw material. They learned lesson 1 early. If the institution makes money by lending yours out, you are not a customer. You are inventory. 2. The entity layer. Here is a question that will change how you think about money forever. Why do the wealthiest people you have ever read about rarely own anything in their own name? Look at the property records in Manhattan. Look at the yacht registries in the Cayman Islands. Look at the car titles in Beverly Hills. The names on those documents are not people, they are letters, they are LLCs, they are trusts. They are holding companies registered in Wyoming or Delaware or Nevada. This is not about hiding. This is about insulation. When you own a house in your personal name and someone slips on your driveway, they can sue you personally. They can come after your savings, your investments, your future earnings. When that same house is owned by a single member LLC, the lawsuit stops at the entity. Your personal wealth sits behind a wall that the legal system, in most cases, cannot pierce. The ultra-wealthy do not own one entity, they own dozens, sometimes hundreds. Each asset, each income stream, each property exists inside its own protective container. If one entity faces a legal challenge, the others are untouched. Think of it like watertight compartments on a ship. One room floods, the ship keeps sailing. Most people put everything, their house, their car, their savings, their business, all under one name, their name. One lawsuit, one judgment, one catastrophic event, and the entire ship goes down. This is not paranoia, this is engineering. 3. The geography of money. Your money has a passport. You just never gave it one. Most people keep 100% of their wealth in one country, under one government, subject to one set of laws that can change with one election cycle. The billionaire class does not operate this way. They practice what is called jurisdictional diversification, and the math behind it is simple. If you have $500,000 entirely in one nation, you are exposed to that nation's inflation policy, its tax changes, its banking regulations, and its political stability. All your eggs, one basket. Now, consider a different structure. 150,000 in a domestic brokerage. 100,000 in a foreign bank account in Singapore, which has some of the strongest banking privacy and capitalization ratios in the world. 100,000 in physical precious metals stored in a private vault in Switzerland. 50,000 in digital assets held in cold storage. The remaining 100,000 in domestic real estate through an LLC. Same $500,000. Radically different risk profile. No single government action, no single banking crisis, no single court order can reach all of it simultaneously. This is not about evading anything. Everything listed is legal and reportable. It is about removing single points of failure from your financial architecture. Now, if this is starting to reshape how you think about where your money actually lives, take 2 seconds to hit the like button. It costs you nothing, and it genuinely helps this channel reach more people who need to hear this. 4. The Trust Fortress. Let me tell you about the single most powerful wealth protection tool in existence, and it is not a stock, it is not real estate, and it is not cryptocurrency. It is a trust. Specifically, an irrevocable trust. When you place assets inside an irrevocable trust, something extraordinary happens. Legally, you no longer own them. The trust does. And because you do not own them, creditors cannot reach them, lawsuits cannot touch them, in many cases, estate taxes cannot claim them. The Walton family, the heirs of Walmart, used a structure called a grantor retained annuity trust to transfer billions of dollars in wealth while minimizing gift and estate taxes to nearly zero. The mechanism is elegant. You place appreciating assets into the trust. You receive a fixed annuity payment back over a set period. If the assets grow faster than the IRS assumed interest rate, the excess passes to your beneficiaries tax-free. On paper, no gift occurred. In reality, generational wealth was transferred. The average person hears the word trust and thinks it is something for the ultra-rich. It is not. You can establish a basic revocable living trust for under $2,000. You can set up an asset protection trust in certain states for marginally more. The point is not the dollar amount inside the trust. The point is the wall it builds around whatever you put there. Even $50,000 protected inside a trust is $50,000. A creditor, a frivolous lawsuit, or an unexpected judgment cannot take from your family. The wealthy do not hoard money. They build invisible architecture around it. 5. The inflation hedge they never taught you. Here is a number that should terrify anyone holding cash in a savings account. Between January 2020 and January 2025, the US dollar lost approximately 23% of its purchasing power. That means if you had $100,000 in savings 5 years ago and did absolutely nothing with it, you now have the equivalent of roughly $77,000 in real spending power. You did not lose a single dollar on paper, but the paper itself became worth less. Banks pay you, at best, 4 to 5% on a high-yield savings account during favorable rate environments. Historically, that number has been closer to 0.5%. Meanwhile, inflation has averaged between 3 and 8% annually over the past 5 years. Your savings account is a melting ice cube dressed up as a safe. The wealthy understand this intimately. They do not hold cash as a store of value. They hold it as a deployment tool, keeping only enough liquidity for short-term needs and opportunities. The rest goes into assets that historically outpace inflation: equity in businesses, income-producing real estate, commodities, and in some cases, hard assets like gold, which has risen over 70% in the last 5 years alone. The principle is not complicated. Cash is for spending, assets are for storing. When you let cash sit in a bank, the bank uses it to create assets for itself. You absorb the inflation loss. They capture the lending profit. You are subsidizing someone else's wealth while yours quietly dissolves. 6. The debt inversion. This is where most people's brains break. The wealthy do not avoid debt. They worship it, but not the kind of debt you are thinking of. They do not carry credit card balances at 22% interest. They use something called securities-based lending, and it is the most elegant financial maneuver most people have never heard of. Here is how it works. Imagine you have $2 million in a stock portfolio. You need $500,000 to buy a property. Most people would sell $500,000 in stock, pay capital gains tax of roughly $100,000, and buy the property with the remaining $400,000. The billionaire does something different. They walk into the bank and say, "I would like to borrow $500,000 against my portfolio." The bank says yes, charges them an interest rate of 2 to 4%, and the billionaire keeps all $2 million in the market, still compounding, still growing, while using the bank's money to buy the property. Read that again. They never sold a share. They never triggered a taxable event. They borrowed at 3% against assets growing at 8 to 10%. The spread between borrowing cost and portfolio growth is pure profit, and the interest on the loan may even be tax deductible depending on how it is structured. This is why billionaires often show minimal taxable income despite living lavish lifestyles. They are not earning income, they are borrowing against wealth. The tax code taxes income, not wealth. The system is not broken, it is built this way, and once you understand it, you can start using smaller versions of the same mechanics. 7. The exit architecture. The final secret is the one no one talks about because it sounds morbid. The wealthiest families in the world spend more time planning how their money survives their death than how it grows during their life. They use a combination of dynasty trusts, family limited partnerships, charitable remainder trusts, and private foundations, not out of generosity alone, but because the tax code rewards these structures enormously. A charitable remainder trust, for example, allows you to place appreciated assets into the trust, receive an income stream for life, get an immediate tax deduction, and upon your passing, the remainder goes to a charitable cause. You reduce your taxable estate, you generate income, and you pay zero capital gains on the appreciated assets placed inside. A dynasty trust, legal in certain states, can hold wealth for multiple generations without ever being subject to estate tax again. You fund it once, it compounds for your children, and their children's children. The average family loses 70% of its wealth by the second generation and 90% by the third. The ultra-wealthy families, the ones whose names you see on buildings and endowments, they lose almost nothing. The difference is not that they made more money. The difference is that they built a system around the money that does not depend on any single person being alive to maintain it. And if you have made it this far and you are genuinely rethinking how you hold and protect what you have earned, consider subscribing. I make videos like this every week, breaking down the financial architecture most people never get taught. Now, let me leave you with 5 things you can do this week. Not next year, this week. First, check your total bank exposure. Add up every dollar you have sitting in savings and checking accounts. If you are above the FDIC insurance limit of $250,000 per depositor per institution, you are unprotected on the excess. Spread it or move it. Second, open a brokerage account if you do not have one. Every dollar sitting idle in a savings account at 0.5% should be considered a slow leak. Even a conservative index fund averaging 7 to 8% annually is 15 times better than most savings rates. Third, research your state's LLC and trust laws. Some states like Wyoming, South Dakota, and Nevada offer extraordinary asset protection structures. You do not need to be wealthy to use them. You need to be strategic. Fourth, call an estate planning attorney this week. Not next month. This week. Ask about a basic revocable trust. The consultation is often free, and the cost of setting one up is a fraction of what a single lawsuit could take from you. Fifth, audit your single points of failure. If one bank freezing your account would paralyze your entire financial life, you have a structural problem that no amount of saving can solve. Diversify your financial geography the same way you would diversify a stock portfolio. Remember the woman in Ohio with $212,000 glowing on her phone screen? She is not poor. She is exposed. And remember the man in Connecticut whose name appears on nothing, whose wealth moves through structures most people will never learn about in school. He is not hiding, he is fortified. The difference between them was never how much they earned, it was how they held what they earned. Banks are tools, powerful tools. But a tool that serves you and a tool that uses you look exactly the same from the outside. The distinction is in the architecture. And architecture, unlike income, is something you build once and benefit from forever. You do not need $400 million to start thinking like someone who has it. You just need to stop trusting glass houses and start building invisible walls. The money you protect today is the freedom you hand to your future self. And that, quietly, is worth more than anything a bank will ever offer you. I am Zik. Thanks for listening. I'll see you in the next video.